Assalamualaikum to Dr. Hanif and my fellow classmates. Today we are delighted to present our academic report titled Analyzing Financial Performance in Banking, Key Driver of Return on Equity and Their Implications. Firstly, I would like to introduce myself, Nasira, and together joining me are my esteemed colleague.
My name is ATHIRAH.
And I am Wafa SYAMIRA.
We represent the Group 1 from class KBA 242PA. To begin, let me provide some context and background on our study. So there will be three focuses in this study that will be highlighted, which are the importance of the banking sector, financial performance, and the impact of the service on ROE. The banking sector is crucial for any economy. It's helped to facilitate the economic activity and ensure financial stability. Banks act as a middleman between those who save money and those who need to borrow it. This role is vital for economic growth and overall prosperity. Simply put, if a bank are doing well, the economy likely to be doing well too. So basically, our study focused on how well banks perform financially using a key measure called return on equity or ROE. ROE tells us how effectively a bank uses the money invested by its shareholder to generate a profit. A higher return on equity means the bank is managed efficiently and financially healthy. This measure is important for investors and stakeholders who want to understand a bank performance. We also look at how different bank services affect the ROE. These services include things like deposits, loan, credit, investments, and managing risks. The efficiency and quality of this service directly impact a bank profitability and efficiency, which in turn affect its return on equity. For example, efficient loan processing and good risk management can lead to higher profit. Moreover, advancement in technology like digital and mobile banking have improved this service, making a bank more efficient and helping to increase ROE. As a consequence, our study aims to analyze what drives ROE in banking sector and what is the mean for the bank and the economy. Therefore, by understanding this factor, banks can improve their performance and contribute to economic growth and stability. Moving forward with our study, we identify the problem statement shown here is to investigate how cybersecurity vulnerabilities impact the financial performance in the banking sector, particularly focusing on return on equity. So what is return on equity? ROE is an important measure that shows how effectively banks use their resources to generate profit. We will investigate how cybersecurity challenges like data breach and identify theft can impact this key performance indicator. This issue not only pose the risk to customer data but also have significant financial implications, potentially leading to loss and reduced profitability. In addition, our study will look at how emerging technologies such as blockchain and artificial intelligence AI can help address this cybersecurity challenge. Blockchain technology is known for its ability to create a secure, tamper-proof record of transactions, which could help reduce the frauds. AI, on the other hand, offers advanced security solutions like multi-factor and biometric authentication, which can strengthen the protection against unauthorized access. By examining the effectiveness of this technology, we aim to understand how they can improve the bank's security and consequently their financial performance. Our goal is to provide insight into how banks can better safeguard their operation, enhance their financial stability, and ultimately improve their return on equity. This will help banks not only protect their customers but also strengthen their overall financial position in the competitive banking industry.
Move to the next part, I will explain about research question and the objective. We provide 4 research questions for this study. The first one is, what are the factors that contribute to a bank performance in terms of return on equity? The second one is, how does dividend yield influence return on equity? The third one is, what is the relationship between price index changes and return on equity? And the last one is, how does return on asset impact return on equity? Next, we move to the objective part. Understanding the factor that drives the performance of banking institution is crucial for stakeholders. ROE serves as a key indicator of a bank profitability, reflecting how effective it uses shareholder equity to generate profit. Our research aims to provide a comprehensive analysis of ROE by examining various financial ratios and their impact. By doing so, we hope to offer valuable insight that can help banks optimize their strategy and enhance profitability. Let's look into the specific objective of our research. The first objective is to identify the factors that contribute to a bank performance in terms of ROE. The next objective is we want to explore how dividend yield influence ROE. The third objective is to investigate the relationship between change in the price index and ROE. And the last one is to assess how ROA impact ROE.
Now, I will be presenting the limitations of our study on analyzing financial performance in the banking sector, with a particular focus on return on equity or ROE. The first limitation is the constraint of the time frame. Although our findings are valuable, they could have been more insightful if the research had been conducted over a longer period. A longer duration will allow us to capture long-term trends, seasonal variations, and delay effect, providing a deeper understanding of the phenomena under investigation. The second limitation is our reliance on the secondary data. While secondary data is available and cost-effective, it may not perfectly align with our study-specific objective. We are considered by the scope, quality, and relevance of the existing data, which might not fully address our research questions or capture the most current trends. Moreover, our limited experience in this field and the scarcity of period research on the topic presented considerable challenges. This limited experience might have affected the various aspects of our studies, including the formulating of research questions, selecting of methodology, and data interpretations. The lack of thorough research makes it difficult to build upon existing findings and establish a solid academic foundation. Next, I will be presenting the implications of our study. Firstly, from this study, provide a framework for banks to optimize their financial performance. Policymakers can utilize this insight to craft regulations that promote stability and growth within the banking sector. Our research aims to provide valuable insight for both financial institutions and policymakers. Furthermore, banking institutions can leverage the study's findings to refine their strategic decision-making process. By understanding the specific driver of ROE, banks can identify areas for improvement and allocate resources for more effectively. This analysis will enable banks to implement target strategies that enhance profitability, such as optimize their loan portfolio and improving operational efficiency. Lastly, the research underscored the importance of risk management in the enhanced financial performance. By identifying the relationship between various financial metrics and ROE, banks can adopt a more proactive approach to risk assessment and management. The insight gained from this study can guide banks in developing comprehensive risk management framework that consider the impact of different financial drivers on overall performance. Now, I will be present about Chapter 2, which is Literature Review based on bank performance in cybersecurity. Cybersecurity has become a paramount concern for the banking industry due to the increasing frequency and subtlety of cyber threats. As banks leverage digital technology to improve operational efficiency and customer experience, they also face higher cybersecurities. These risks can compromise operational stability, financial performance, and reputation. Research has focused on understanding the intricate relationship between cybersecurity and bank performance. Identifying key determinants and addressing gaps in this field is critical to mitigating risk and ensuring resilience, and ultimately maintaining a positive ROE. Executive management play a critical role in reinforcing cybersecurity initiatives. Their support is vital to establish a cybersecurity culture and providing strategic direction. Research by Lawrence Demlet Oil LI show that executive engagement fosters a culture of security and accountability, supporting effective risk management, and enhance ROE. Secondly, based on other issues related to bank performance, the study by Simit Al-Mau explored the effect of regulatory framework on bank performance. While regulations are critical for maintaining stability and reducing risk, their design and executions have complex effect on ROE. Tailoring regulatory framework to specific bank characteristics can balance stabilities and innovations to optimize ROE. Research by Sandra examined the impact of economic progress on banking performance across different regions. Their findings highlight significant disparities, with Sub-Saharan Africa facing highest level of non-performing loans and declining deposit rate despite economic growth negatively impacting ROE. Radiatu Putra and Mohd, Danang Bhatia focus on their impact on the COVID-19 pandemic on Indonesian financial sector. The pandemic significantly affected various aspects of banking performance, including capital adequacy, profitability, efficiency, and liquidity, all of which are critical to maintain a strong ROE. Next, I will discuss the theoretical framework that are fundamental to understanding bank performance. We will deal with the theory of agency cost and the theory of trade, exploring how this paradigm illuminate the dynamic within the banking sector and their implication for performance evaluations. Firstly, for theory of agency cost, the theory of agency cost introduced by Jensen and McLean in 1976, addressed the inherent conflict of interest between principals and agents within the organizations. This theory is particularly relevant in the banking sector, where ownership and control are often separate. In bank, decision-making authorized is typically delegated to management, which can lead to a divergence from shareholder wealth maximization. This misalignment results in agency costs, which are expenses incurred by shareholders to monitor and limited managerial opportunities. Secondly, theory of trade. The theory of trade, particularly in its international dimensions, explain how nations leverage their comprehensive advantages in producing goods and services to optimize efficiency and welfare. In the banking domain, this theory helps us understand how banks deal with their operations to capitalize on their inherent strength. Bank adopt specialization strategies focused on specific financial products or services such as retail banking, corporate banking, and investment banking. These strategies are based on factors like expertise, resources, and market dynamic. Specializations help banks achieve economies of scale and scope, thereby enhancing performance. The theory of trade also underscores the benefit of globalizations and cross-border activities in banking. By engaging the international trade, banks can diversify risk operation in different economic situations, and regulation regimes help manage with exposure and hedge against local market uncertainty. Banks also can augment revenue stream, access to diverse market and revenue opportunities. Next, banks also can innovate and participations in dynamic financial ecosystem, foster innovation and competitiveness. The end of chapter 2, I will be presenting an analysis of key financial ratios that impact return on equity, and they are significant in evaluating a company's financial health, particularly in the banking sector. Let's begin with return on equity, or ROE. This financial metric is used to measure company profitability in relation to the equity held by its shareholders. It shows how well a business generates net income from the equity invested by its owners. Next, we have return on asset. This metric assesses a company profitability concerning its total asset, ROA is a significant measure for investor and analysis evaluations accompany profitability and operational efficiency. Now, let's discuss dividend yield. This statistic calculates the percentage return from dividend relations relative to the stock price. It's particularly significant for income investor looking for consistent return. Lastly, we have the price index. This statistical measure track change in the price of the set basket of goods and service over time, helping us to understand inflation or deflation trend.
Now, I will be presenting Chapter 3 of our thesis, which cover the research methodology. This chapter is crucial as it outlines the structured approach used to investigate the impact of emerging technology like blockchains and artificial intelligence of profitability of bank. The research methodology is a cornerstone of empirical inquiry. It provides a structured approach to investigate complex phenomena, draw meaningful conclusions, and contribute to existing body of knowledge. We have chosen quantitative research approach to assess the relationship between key financial performance indicator, which is return on asset, dividend yield, and price index, and the dependent variable is return on equity. Moving on the research design, we employ both basic and applied research method to gather and analyze data. Let's look into the specifics of each method. Our basic research involves collecting and analyzing data from a selection of banking institutions. We gather financial statements, annual report, and other relevant documents to obtain comprehensive information about the bank's financial performance. Key indicators such as operating margin, return on asset, net profit margin, and ROE were calculated and compared across the sample. This method emphasizes quantitative analysis and aims to provide descriptive overview of a strategic bank used to enhance their financial performance and their impact on overall profitability. By analyzing various financial metrics, we identify trends, pattern, and variation in how different banks achieve higher ROE. This approach lays the groundwork for further investigation. Next, for applied research, we analyze numerical data from sources such as financial statement and performance metric. Statistical analysis was conducted on a key indicator including investment in financial strategies, cost efficiency measure, revenue stream, and financial measure like operating margin, return on asset, and return on equity. Furthermore, we use quantitative method to examine industry report, case study, and benchmarking data to compare the financial efficiency of banks across various nations and or areas. This applied research method provides an understanding of various variables influencing and efficient financial operation, aiding in identifying areas for improvement such as factor and best practice. We move to the next part, which we will discuss the data and sources used in our study. It is focusing on primary and secondary data collection method. First, let's talk about primary data collections. Primary data collection methods are fundamental tools in research, allowing us to gather first-hand information directly from original sources. This approach ensures that the data is accurate and relevant to our specific research objective. This direct approach to data collection ensures that the information gathered is specifically aligned with the research question. Example of primary data collection method is survey, interview, and observation. Survey involves structured questionnaire distributed to a sample population to gather quantitative data on various topics. Interview provides qualitative insight through direct, in-depth conversation between the researcher and participant, while observation involves systematically recording behavior, event, or condition as they occur in their national setting. Each of these methods has unique advantage, enable the collection of rich, detailing data that is difficult to obtain through secondary sources. Now, let's move on to the secondary data collections. Secondary data refer to the information that has already been collected by someone else for purpose other than their specific research question at hand. Researchers analyze and interpret this existing information rather than collecting new data themselves. Secondary data can be found in various sources such as magazine, newspaper, book, academic journal, government report, industry statistics, and scholarship article. These sources often undergo rigorous validation and peer review process, ensuring their credibility. Published data is readily accessible to the public, while unpublished data may include internal company report, private communication, and other non-publicly released information. Accessing unpublished data might require specific permission or agreement with the data owner. So, in the context of this study, we will focus on secondary data, relying on pre-existing data sources rather than gather new data through primary research method. We will analyze information from various secondary sources, such as the World Bank data website, covering a period of 5 years from 2019 to 2024. This approach saves time and research, allowing us to leverage existing information that has already been validated by other experts. By utilizing a broad spectrum of previously gathered data, we can gain comprehensive insight and draw real information conclusions. Move to the last part of Chapter 3, which is type of research used in our study. It is quantitative analysis and time series analysis, and this method helps us understand the financial performance in banking, particularly focused on return on equity. Firstly, quantitative analysis. This approach uses statistical mathematical technique to analyze numerical data. It helps us quantify relationship, pattern, and trend within the data, leading to the objective and data-driven conclusions. Quantitative analysis is widely used in various fields such as finance, economic, and social science. For instance, it helps evaluate market trend, assess financial risk, and predict stock price. In our study, we used to analyze financial performance in banking by examining key drivers of ROE. To analyze ROE, we collect and examine data on variables like price index, dividend yield, and return on asset. By using statistical techniques like multiple regression analysis, we determine the strength and nature of relationship between this variable and ROE. For example, a strong positive correlation between ROE and ROE indicates that higher asset return contributes significantly to equity return. Understanding this relationship helps banks formulate strategies to enhance ROE, such as optimizing asset utilization or adjusting dividends policy. Next type of research are time series analysis. This method is used to examine data points collected at consistent interval over time. It helps us monitor change and trend in financial performance metric, focusing on ROE and its key driver over a specific period. To ensure our analysis is relevant, we incorporate article and research from latest 5 years. This contemporary literature provides insight into recent trends, challenges, and advancements in financial performance, ensuring our study reflects the latest industry standard. The primary objective of time series analysis in our study are to identify significant trends over time, evaluate the effectiveness of financial strategy, predict future performance based on historical data, and provide evidence based on recommendation for optimizing financial performance strategies. By employing time series analysis, we gain comprehensive temporal perspective on the relationship between financial strategy and ROE. This dynamic analysis helps pinpoint critical period of change, assess long-term impact, and guide banking institutions in development more effective financial policy.
Thank you, ATHIRAH, for the presentation, Chapter 3. So now let's continue to Chapter 4, Data Analysis. In this chapter, we will see the data analysis process, starting with a detailed examination of our data collection and preparation method. We will then present the descriptive statistics, summarize key features of the data set, followed by an overview of the research result to highlight the main findings and their implications. Finally, we will conduct a regression analysis to uncover the relationship between a variable and their impact on return on equity. So basically, This presentation on Chapter 4 will provide insight into the key driver of financial performance in the banking sector. In this study, we use eView version 12 software to analyze the performance of bank, focusing on the return on equity as our main measure of interest. We apply the least square regression method to examine how their independent variable, dividend yield, return on asset, and price index affect the ROE. Group was to identify the key driver of ROE and assess their statistical significance. As can be seen here, the result indicate that the overall regression model is effective as evidenced by F statistic below the 0.05 significant level. This suggests that the model adequately captured the relationship between the ROE and these three independent variables. However, the Darwin Watson statistic of 1.14 point to some degree of autocorrelation in the residual, which may need further explorations. Despite this, the analysis highlight dividend yield, ROA, and price index as significant drivers of the return on equity in banking sector. This finding offer valuable insight for investor and financial analysts, emphasizing the importance of this variable in understanding and evaluating the bank performance. Next, we move to research result. The table currently displayed are the result of our data analysis using the least square methods, focusing on return on equity, ROE, as the dependent variable. The analysis includes 14 observations from the World Bank datasets and examine the impact of three independent variables, which is the dividend yield, return on asset, and price index. From the dataset, the results show a significant positive relationship between dividend yield and ROE. With a coefficient of 1.177, a 1 unit increase in dividend yield leads to an approximate 1.177 increase in ROE. The p-value of 0.0084, which is below the 0.05 threshold, confirms this finding is statistically significant. This suggests that higher dividend payouts are linked to improved bank performance and may boost investor confidence. Return on asset also show a positive relationship with return on equity, with a coefficient of 0.0854. This means that an increase in ROA is generally lead to a higher ROE. However, the p-value of 0.0566 is just above the 0.05 cutoff, indicating that while the trend is positive, it's not statistically significant at 5% level. This suggests that the impact of ROA on ROE is not yet firmly established and might require further investigation. While for the price index, the dataset show a positive effect on ROE as well, with a coefficient of 0.0028. For each unit increase in the price index, ROE is increased by about 0.0028. The p-value of 0.0103 indicate that the relationship is statistically significant, highlighting the better market conditions are associated with a higher ROE. This finding support that the hypothesis that market trend impact the bank performance. Overall, the dataset result explain approximately 58% of the variation in ROE as indicating by the R-square value of 0.580, the adjusted R-square value of 0.504 suggested that these variables are meaningful predictor of ROE even after accounting for the number of predictors. This model provides a good fit for explaining bank performance based on these key financial indicators. In this concluding section of Chapter 4, we present the result of our regression analysis, which is designed to evaluate the impact of various financial indicators on return on equity. This analysis tests three key hypotheses regarding the relationship between the ROE and the three independent variables: return on asset, dividend yield, and the price index. By applying regression techniques, we aim to understand how changes in this variable influence the ROE and assess their statistical significance. As can be seen here, the table summarizes the result of our hypothesis testing regarding the factor affecting bank return on equity. We tested the three hypotheses related to ROE and found significant insights. The first hypothesis one examined whether the return on assets impact the ROE. The results show coefficient of 0.854 for ROA with a T statistic of 2.13 and a p-value of 0.0566. Although the p-value is slightly above the conventional 0.05 level, it is close enough to consider the impact of ROA on ROE as marginally significant. Thus, hypothesis 1 is accepted and suggesting that a return on asset does influence the return on equity, though the evidence is not as strong as it could be. Next hypothesis show how hypothesis 2 explore the effect of dividend yield on the return on equity. The coefficient of dividend yield is 1.177 with a T statistic of 3.21 and p-value of 0.084. Since the p-value is well below 0.05, the result is statistically significant. Therefore, hypothesis 2 is accepted, indicating the higher dividend yield are a strong predictor of higher return on equity. And last hypothesis 3 investigating whether the price index affect the return on equity. The analysis revealed the coefficient of 0.0028 for the price index with a T statistic of 3.09 and a p-value of 0.0103. This p-value is also below the 0.05 threshold, showing a significant relationship. Hence, hypothesis 3 is accepted, confirming the price of index significantly impact the return on equity. In summary, the regression analysis support all three hypotheses, demonstrate that the ROA, dividend yield, and the price index are important factors influencing the bank performance. This finding highlight the critical roles of this variable in determining the ROE.
Now we move to the last chapter, which is chapter 5, and we will discuss about the discussion part. This chapter aims to provide a thorough analysis of the conclusion drawn from the previous chapter investigation on the effect of profitability variable on the banking sector. The cybersecurity research result highlight how important cybersecurity is to sustaining bank success, especially when it comes to ROE. The study demonstrates how cutting-edge technology like artificial intelligence and blockchains may improve security protocol, lowering the chance of financial losses and cyber attack. Furthermore, the involvement of executive management in reinforcing cybersecurity initiatives is crucial for fostering a security-conscious culture and ensuring effective allocation of research. The positive correlation between cybersecurity investment and financial performance underscore the importance of prioritizing cybersecurity to sustain long-term competitive and positive ROE.
In Chapter 5, we also examine the role of regulatory framework in influencing bank performance, particularly focusing on return on equity ROE. Regulatory compliance often involves substantial costs for banks as they must adhere to the strictened data protection law, financial regulation, and industry standards. However, these regulatory requirements are not merely a financial burden, they play a crucial role in enhancing the overall stability of the banking sector and building investor confidence. Effective regulatory framework help to ensure that banks operate in a source that's transparent manner which can positively impact the ROE by fostering a stable environment that attracts the investor. By successfully navigating the complexity of this regulation, banks can mitigate the risk, avoid the cost penalty, and maintain a strong reputation in the market. Furthermore, as banks undergo digital transformation, balancing innovative with regulatory compliance becomes essential. Adapting to technological advancements while adhering to regulatory standards allow banks to optimize their operation and improve their financial performance. This balanced approach not only support regulatory compliance but also enhance the return on equity by leveraging technology to drive efficiency and growth. Therefore, in this discussion, the regulatory framework may impose costs that are integral to maintain a stable and trustworthy banking environment. By effectively managing these regulations, banks can boost investor confidence and maximize the ROE, ultimately contributing to their long-term success.
As I end up our presentation, I would like to share the conclusions drawn from our study. In conclusion, our study found that return on equity in Malaysian banking sector is influenced by dividend yield, price index, and return on asset. However, the study limited time frame and reliance of secondary data suggests the need for future research. Extending the study's period and incorporating primary data can provide a more comprehensive understanding of this relationship. For future, research should also consider the impact of digital banking, fintech, blockchain, AI, regulatory change and economic condition on ROE.